This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Up until now, we've only made references to the fact that, of course, an unincorporated trade, at the moment for us just sole traders, may sustain a trading loss rather than a tax-adjusted trading profit. In which case, what do we know about that? Well, as we see in the introduction here to Chapter 7, the chapter that will deal with the detail of trading losses, the things that we do know. We know that if the basis period for a tax year has a trading loss, trading profit assessment is nil. We never put a negative figure in relation to our income tax computation. We put in nil. So if, for example, our business had prepared accounts to the year ended 31st of December 17, that accounting period, using our CYB basis of assessment, it ends in the 17-18 tax year. It would therefore be assessed in 2017-18. And if that accounting period has given rise to a loss, we can make a number up, say £30,000 worth of trading loss. Then on the income tax computation for this tax year 17-18, we put in nil. What we must then separately do is to consider what are the various loss reliefs. Now on this too, we've actually had an introduction way back in our first technical lecture, the beginning of Chapter 2 that kicked off the income tax work that we've been doing ever since. We saw on page 5 of your notes a pro forma income tax computation. Let me remind you of that now by just taking you back to that. So there was our pro forma income tax computation for our tax year. And what did we see? As well as what I hope we are very familiar with now, the analysis of our income in terms of non-savings income, savings income and dividend income. The trading profit, a major form of non-savings income. And what did we see there going directly against it? If we'd had a trading loss brought forward from a previous tax year, made in an earlier accounting period, then that trading loss brought forward would now automatically go against the trading profit of this particular tax year, of this period. And further down, having calculated total income, and after firstly deducting any qualifying loan interest payments, then we would have any other trading loss reliefs. So there are 2 points on our income tax computation where these loss reliefs may apply. Either with a brought forward loss directly against the trading profit assessment of this period, or for other loss reliefs, we'll see they are losses made either in the current year or indeed in the following year, or possibly even in an even later tax year than that, but have been brought back to this year. They go against total income. Here, those other trading loss reliefs. What we therefore got to do wherever we see losses being involved on an income tax computation, always leave a gap after trading profit into which, if necessary, the trading loss brought forward can then be deducted. And always leave a gap after total income before net income into which any of these other trading loss reliefs may go. What we'll do is we'll just get used to the idea of a gap after trading income, a gap after total income into which those loss reliefs can go. And it's a technique that we'll also use when eventually we come to the second most major taxation in our syllabus, corporation tax. Because also when companies sustain trading losses and we have to do corporate tax computations, we're going to follow some very similar rules. Again, if a company makes a trading loss, the assessment on the corporate tax computation this time will be nil. And we must then separately consider what we can do with that. And just like with unincorporated trades, there's a capacity to carry forward. And if we do carry forward, then it goes against future trading profits, as we'll see of the same trade. And then if we are going to relieve that loss sooner, either in the current year or possibly thereafter a previous year, then it will go against not total income, but what we have on a corporate tax computation, total profits. So again, we'll get used to the idea of trading income, gap into which a brought forward loss can apply, work down here on an income tax computation to total income, gap into which other trading loss reliefs can go, and on a corporate tax computation, we'll get, when we see it later in our studies, to total profits, and again, leave a gap into which the loss reliefs may apply. If you get used to the idea of those gaps, after trading income, after total income on the income tax comp, after total profits on the corporation tax comp, you won't even have to think twice about where those loss reliefs apply. You've already got the gaps ready made. Makes it easier for you to know how and where you will use those losses. You, of course, will still have to decide, given the specific circumstances, either here in income tax for the individual or in corporate tax for the company, which of the available loss reliefs it may be better to claim. There is a choice element, and that demands, therefore, skill on your part in terms of, what am I trying to do here? Well, clearly, I'm trying to get the best use out of that loss so far as the taxpayer is concerned. So we'll see later in our Chapter 7, so let's return to that now. We'll see later in this Chapter 7 about the objectives that we would have here for an individual to try to get the best use out of those losses. We'll bring those together to apply that and therefore achieve what will be, in principle, the biggest and most immediate tax saving that can be achieved by the use of the loss. Again, I think it is an obvious statement that we've used before, that if HMRC are going to tax us on trading profits, then they must give us reliefs for losses. But of course, those reliefs that are available are laid down in statute by HMRC, and we must work within those constraints. So what, therefore, are those reliefs? And as we said, where do they go? Well, the reliefs available. It will come as no surprise, given what we've just been talking about and what we've just seen on the income tax computation, that one option is to carry forward against, as I said, future trading profits of the same trade. Now that, once a loss is carried forward, you cease to have any choice in the matter. When a loss goes forward, then it will go against the next available future trading profit of that same trade. You cannot go forward to the next year and say, oh, you know what, I think this year's trading profit is so small, I won't bother. It's not an option. It will go against all of the next available future trading profit until such time as the loss is used or until the trade ceases. It goes forward against the future trading profits of the same trade. Relief, of course, can be obtained rather more generously and rather more immediately against, well, there it is, total income of the current and or the preceding tax year. Now, you know where total income is on your income tax computation, and we've got a choice here that we can put the loss against the total income of the current tax year and or the preceding tax year. The details of that, of course, coming up soon. If I just skip there to D, just to keep this in the same idea, when we deal with new businesses and businesses that cease to trade, what we've already seen in the previous chapter is that we have to have our own specific bases of assessment to apply within those particular tax years. We had special rules to relate the accounting periods in which there were profits to the tax years in which they would be assessed. We've got to follow that through and deal with the specifics of loss reliefs. And what we'll see is that there are specialist loss reliefs that are only applicable in the opening years of a new trade, or which are only applicable at the cessation of trade, as compared to what we've spoken of at the moment, which is whenever the loss is incurred on any ongoing business, we could set off against the total income of the current tax year and or the preceding tax year, or we could carry forward against future trading profits or have some combination of those particular reliefs, depending on how big that loss may be. But there are special rules, firstly in opening years, which allows our loss sustained to go against total income. Again, total income here, this time of the preceding 3 tax years. So rather than just a carry back of 1 year, if you make a loss in the opening years, we'll specifically define, of course, which years we mean by the opening years there. Then we get the capacity to carry it back even further. It means that if in the very first tax year in which you have traded, you should sustain a trading loss, then that specialist opening years relief would allow you to carry the loss back against total income of the preceding 3 tax years. You could go back 3 tax years in terms of setting off against income, total income, that arose years before you had even thought about setting up in your own trade. So again, a generous loss relief, and again one that would allow, by carry back, to reduce the income of earlier years that should have been charged to tax. That therefore would give a lower tax figure, maybe even a nil tax figure for those years. But by now, 3 years on, 2 years on, 1 year on from that, by now we may of course have the situation where, that the tax for those years or year has already been paid. We have therefore overpaid. So what these carry-back reliefs can do for us is to generate a repayment. So in cash flow terms, that's very good news, isn't it? If we submit our claim for our loss relief, going back to an earlier tax year, reducing the tax liability and tax payable of that year, but we've already paid the tax payable figure, then we will get a repayment of that tax. So good news there. And then terminal loss relief. Very, very specific, just dealing with cessation of trading. Exactly, again, how we calculate these losses we see later in the specific notes on each of these individual losses. And here we can go back again 3 years, but this time against trading profits. So we are seeing, in terms of these reliefs against income, either against total income for an ongoing business from the very first year to indeed the very final tax year, let alone in between, we can set off against the total income of the current tax year and or the preceding tax year. In opening years, we get the ability to go back even further against total income of the preceding 3 tax years. If a loss is to be carried forward, as we firstly saw there, then it will go against the future trading profits of the same trade. If, of course, you are ceasing to trade, as per this one, cessation of trade, then, of course, there's no future trading profits to carry the loss forward to, which is why here our terminal loss relief says, right, okay, if you've ceased trading, there is no future trading profit. I tell you what, we'll allow you to go back against the trading profits of the previous 3 tax years, giving you a better opportunity to gain some use out of that loss. Because if you can't use it in any of these ways or any other ways, then that's it. Any unused loss will otherwise lapse. We missed out one in the middle. That's a very specialist one. And it is one that is only available following a claim in B. This one here. If you have made a claim against total income, whether it be for the current tax year or for the preceding tax year, or both, if after such a claim against total income, there is still loss remaining, so the loss is bigger than the total income against which you have offset that loss, you'll have reduced the total income to nil. There is still loss left over. Then if you wish, you can now change the very nature of that loss. That rather than going against income on an income tax computation, you can actually turn what is a trading loss within income tax into a capital loss that is relevant in capital gains tax. So the rule here is that if any trading loss still remains, the taxpayer may choose to extend the loss claim against chargeable gains of that tax year, the one in which you have claimed the relief against total income. Now, each of these areas of relief have their own very special rules. You've got the gist of it now, I trust. That's what we're going to be doing in the entirety of this chapter. But have that overview set in your mind to begin with. On a normal ongoing trader, normal ongoing business, not dealing with opening years, not dealing with cessation, we have the options of set against total income, of current tax year, and or preceding tax year. So you can go against one or other of those years. You could go against both years and decide which order in which to take the loss against the total incomes of those years. Any loss that remains still after that, there is only one thing to do with it: carry it forward against the future trading profits of that same trade. If you've made a claim in any tax year against total income, using, that's either the current tax year or the preceding tax year claim for our ongoing business. If you've done that and there's still loss left over, then have a little look at the capital gains position, because you may then be able to extend that loss relief claim against your chargeable gains. Other than that, specialist relief in opening years, still a claim against total income, but this time a claim against the total income of the preceding 3 tax years, allowing you more immediate relief for the loss, but that is one single claim, as we'll see in the detailed note, that goes against all of those preceding 3 tax years. And on cessation, once we've computed it, we've got to see what we mean by this terminal loss. Once we've calculated that figure, then we can go back against trading income assessed within the preceding 3 tax years. Okay, the detail now. Well, to begin with, a very simple one, the carry forward of the trading loss. As we kept saying, it goes against the first trading profits arising from the same trade. There's no choice as regards its application. It will go against the first available future trading profit of the same trade there. The trading loss must be set off in full. As we have said, you cannot make partial claims. You cannot skip any years. Any loss remaining is carried forward until further profits arise, and the loss may be carried forward indefinitely. The only thing that would cause any of this loss to lapse is if this trade ceased trading, for as we have seen, it may only go forward against future trading profits of the same trade. Here's a very simple, therefore, first example. But let's get into good habits here, and that is, if you have a loss relief example, now this may span, of course, several tax years. So if we're doing a working, if we're presenting this in our answer, or indeed just so that we understand how to get an answer, should it be an objective testing question, more easily, we will use a columnar analysis, a column for each tax year. So what are we told here? We've got to calculate his assessable amounts for all relevant tax years. So Albert has had the following recent trading results as adjusted for taxation. So as we can see, Albert prepares accounts each year to the 31st of December. So using a CYB assessment, we place next to that on our question page here the tax years in which we will be assessing these periods, and year ended December 16 ends in 1617. December 17 obviously assessed in 1718 through to the year ended December 18, that ends in the 1819 tax year, that is the tax year. We know that in 1718 we would be assessing £3,000 of profit. In 1819, 10,000. In 1617, we will have a nil assessment. We use a columnar approach. We now know our tax years, 1617, 1718, and 1819. We know our trading income figures here. In 1617, the assessment, nil, followed by 3,000 and 10,000. Now, as we'll see as we go through this chapter, we'd anticipate in an exam standard question anyway, other amounts, other sources of income coming into these particular tax years. But this is all we have. So all we can do here with this loss is to carry it forward. So trading loss brought forward into each year. We had a loss of £5,000. No choice. It will relieve against all of the next available future trading profit. That was 3,000, which of course will bring that assessment down to nil, and therefore the total income down to nil. This is the only source of income the taxpayer here has in this problem, and therefore there will be no income, there will be no tax to pay. Then carry forward. How much loss do we have left over? We sustained a loss of 5,000. We've used 3, so there's 2,000 there to use, bringing that down to 8,000. Now there would be no choice as regards the use of that loss. If we haven't got any other income of the current tax year or preceding tax year, all you can do with the loss is to carry it forward. And if you look at those numbers, you will also realise that in fact here, that loss has achieved nothing in the form of tax saving. Because of course each year you would have a personal allowance available. Now again, you'll be told just to assume that what is the personal allowance relevant for 1718 will apply throughout. So we'd have had an £11,500 personal allowance here in each of these years. So because we had no income there, 3,000 there, 10,000 there, that personal allowance would anyway have covered those figures of trading income. But with that loss, there is no other option. It will go forward against the next available future trading profit. You can't say, I won't put it against the 3 because I've already got my personal allowance. I won't put it against the 10 because I've already got my personal allowance. You can't do that. Next available future trading profit. Okay, but as we've said, we're likely to see a mix of the carry forward and the rather more immediate relief in the current and preceding year against total income. Now, by all means, of course, again, just check through with the answer in the back to that first exercise there, just to make sure that you are comfortable with that and the notes that attach to it. But then we now move on to look at the more likely involvement of loss relief against total income. So what do we know about this? Trading loss may be relieved against total income. That, if there are any, would be after the deduction of the qualifying loan interest payments. They take precedence of the tax year of the loss and or the preceding tax year. Now, let's just have an illustration to see what we're talking about here. So, if therefore we had the accounting year ended the 30th of June 17, and in which we had a £30,000 loss. What do we know? We know that in the current tax year, that current tax year therefore will be the 1718 tax year, year ended June 17 ends in the 1718 tax year, that there will be a nil assessment. What loss reliefs are now available? The loss reliefs available, firstly, against total income of the current tax year. What have we already agreed the current tax year to be? It is 1718. And or the preceding tax year. So if we know, as we have already determined, that the current tax year is 1718, then the preceding tax year must be 1617. So we get to choose whether or not to set the loss off against the total income of the current tax year, 1718, and or that of the preceding tax year, 1617. The relief is against total income. Now again, as we saw a moment ago, in that first example where the only income was trading income, there was nothing else, If you go against total income is before the deduction of the personal allowance. So a problem that attaches very specifically to this particular relief, and any relief that goes against total income, is that as you cannot control, as you cannot make partial claims, if you make the claim all of the loss goes against all of the total income, then in this particular claim you run the risk of again wasting the personal allowance. Clearly something that you would not wish to do. So that's going to be one of the objectives that we would have for ourselves, that we'll list out later, about what you'd be trying to do to get the best use out of your losses. One objective would be to avoid wasting the personal allowance. But of course what these loss reliefs do, as compared to the carry forward, is to allow you a more immediate use of the loss. If you are able to, and you choose to, as would probably be the most likely claim here, we'll talk about why in a moment, to go against the total income of the preceding tax year, then by this point in time, you will already have paid the tax for that preceding tax year. So in cash flow terms, the ability to go back, reduce the income, reduce or indeed eliminate entirely the tax payable figure of the preceding year, but it is a figure you have already paid, you get a repayment back from HMRC. So in cash flow terms, that's a lot better than, as we saw in example 1, carrying forward to reduce a future trading profit, which then in turn for the tax year in which that future profit would be assessed, then you would be paying tax at a later point in time. So in cash flow terms, this is a lot better. Clearly, to go back to the preceding year would generate a repayment of tax you had already paid. If it's in the current tax year, then you're simply reducing, or again eliminating, the tax that would otherwise have been payable in relation to this year. Now, that date has probably not yet arrived, but it is still going to be an earlier date than would be achieved through a carry forward claim. So this therefore has got cash flow advantages as compared to carry forward, but it's also got a problem of potentially wasting the personal allowance. All issues that we'll have to have on board with us in our heads there when we look at and analyse a problem in the examination room. So it goes against the total income of current tax year and or preceding tax year, if of course after that there was still loss left over, and that, as we've seen, is carried forward against the future trading profits of the same trade. So there are our options therefore. Okay, let's just return to our notes here and have a little review through what we've just been talking about. The loss, of course, is calculated by reference to the accounting period in which it arose. That example a moment ago was the year ended the 30th of June 17. The accounting period is then assessed using the normal bases of assessment. So as we saw, if we had a year ended 30th of June 17, that could be relieved against the total income of the current year, 17-18, because that ends in the 17-18 tax year. Do hope we understand our bases of assessment, otherwise we're going to struggle with these loss reliefs. The tax year of loss, using CYB as the basis of assessment, and all the preceding tax year, 16-17 there. If relief against total income is taken, the loss must be set off to the maximum possible extent, subject to a cap on income tax reliefs. We'll see that in a later section, section C here below. Seldom does it apply, but we need to be aware of that. There is potentially a limiting factor that may limit it. The limitation would be at a minimum £50,000, as we'll see very soon. So it's a big number there. Personal allowances may therefore be lost when you go against total income if the loss, subject to your cap of 50,000, at least 50,000. If you eliminate all of the total income, you've wasted the personal allowance. You would not wish to use a loss to reduce income that would not anyway have had any tax to pay upon it. If we could have left the income, it would be covered by the personal allowance. and therefore you'd have paid no tax. However, these reliefs go against total income, and you don't get, I repeat, to make partial claims. As we said, it was before the deduction of the personal allowance, no partial claims. A claim against total income, as we know, may be made either tax year of loss or the previous year or both. Again, those 2 years stand alone. We're free to make our own decision about which to use there. Right. Oh, now I said to you when we looked at that loss that the claim against the preceding tax year was probably the more likely one. The reason being, for most individuals who have trades, their main, if not only, as in the previous example, source of income will be the profit generated from that trade. So if in the current tax year you have a loss, the assessment is nil. So unless you've actually got other income in excess of your personal allowance, for us 11,500, unless you've got that other income, there's no need to make a current year claim because you're not going to pay any tax anyway. If I've got other income of £10,000, I'm not going to make a loss claim of using 10,000 of my loss that, if not used here, could be used against the income of another year. I'm not going to use it now to take out £10,000 of income that I wouldn't be paying any tax on anyway, because from that income I would be deducting my personal allowance. Remember, if a personal allowance is unused, it's wasted. You don't get to carry forward an unused personal allowance. You either use it or you lose it. That is the rule. So in which case, we would rather use the personal allowance to reduce income, allowing the loss to be preserved, because if it's not used in this year, if this were the current year, it could go back to the preceding tax year, or if that's not a particularly good use of it, then at least it could carry forward against future trading profits of the same trade there. So again, important issues to think in terms of. Now we've got example 2 here that's a wee bit more interesting, and I'll be wanting you to have a go at this, given what we've said so far. Now let's look at how we deal with it. We've got to compute here Charles's taxable income for each relevant tax year, assuming that the trading loss is used in the most beneficial way. Make your mind up time. We have to decide what we think is the best possible use of the loss. Now, again, the best possible use isn't always the very, very best use that in another circumstance could have been achieved. It may still involve some wastage of a personal allowance. You don't always get it so that perfectly you do not waste any personal allowance and you'll get the most immediate relief. Again, we do not live in a perfect world. So let's have a look at what we've got here, therefore, and also work out trading losses will continue for the next few years. And of course, as we always do, we assume the personal allowance there to remain the same in all those tax years, or 11,500. Now that little note there about trading losses will continue in the next few years. What that means is, if we can get any reasonable use of the loss now against the total income of the current year and or the preceding year, then that would seem like a good idea. Let's get something at least back in terms of an income tax reduction, maybe an income tax repayment if it goes against the total income of the preceding tax year, rather than just carrying forward because there's no immediate prospect of a future trading profit. That's going to be longer term. So let's take what we can get at this point in time. So what do? We've got our years ended December, 16, 17, 18. They will therefore be assessed in 16, 17, 17, 18. And what is our year of loss? The year ended December 18. That, of course, will be assessed in 18, 19. And as we know, will give rise to a nil assessment. Charles here also has other property income in each year of £6,000. So what you now need to do, as we saw in the first example we did, is we set up a columnar working our tax years 16-17 through 17-18 and into 18-19. We will have our trading income figures and we will have our property income figures. And now, the beauty of these, if it is a Section C question, is so much of your answer comes directly by just copying numbers down from the question. So what have we got as trading income assessments? We've got 32,000, 25,000, and of course nil, it being this great big loss of 84,000 that's been sustained. What have we got in the way of property income? We've got £6,000 in each year. That would give us our total income figures. They are 38,000, 31,000 and 6,000. Now we know of course that one option was to carry forward all of the loss of 84, but as we've said, given the fact that we're making yet more losses for the next few years, well, there's no guarantee that the business will get through that. Let's cash in, usefully anyway, whatever loss and achieve whatever income tax saving we possibly can at this point in time. But again, that doesn't necessarily mean that we will claim the relief against the total income of both the current tax year and or the preceding tax year. So which are the 2 years in question? There is your current tax year, 18-19, so there is your preceding tax year, 17-18. So 16-17 here, we can't touch. The only reliefs that we can claim that we have seen here are against total income of the current year, that is £6,000, and or the preceding year, 31,000. Well, you answer me this. Are you going to make a claim against the total income of this, the current tax year? Are you really going to use 6,000 of your loss of 84,000 to go against that £6,000 of income? Now, I hope you're going to be telling me here now, it's going through your heads, no. Because, of course, what would you already have available in each of these years? A personal allowance of £11,500. Again, we use the same figures across the board here, would be available. So we know that in terms of taxable income, that's going to be nil anyway. So do you get the point? You are not going to make a claim against the total income of, on this occasion, the current tax year, when there's nothing, of course, that's going to be paid on it anyway. The personal allowance already covers that. So in which case, other than carry forward, the only other option is 31,000. How much loss do we have? We have 84,000. That means as the loss is bigger than the total income, the 31,000 we see here, then there is only one possibility. You will set off against all of that total income of 31,000. The loss that would go in, it would go in the gap here after total income. It would go against that 31. You can't just use sufficient of the loss to bring that 31,000 down to 11,500. It's not an option. We'd love to be able to do it, but we're not allowed partial claims. So although again it means that we'll be wasting the personal allowance, at least we'll be getting some income tax saving. What would have been 31,000 total income, less personal allowance 11,500, that would have left, what would that be, £19,500 worth of taxable income. Well, if we use 31,000 of the loss, we're going to save paying that income tax on 20%, it's all basic rate of course here, of £19,500. Not only do we say we save paying on that, we've already paid on it. By the time we've got to 18-19, we'll already have paid the tax for 17-18. So our tax repayment that this loss claim will generate will of course be the 20% of the £19,500. Whatever that comes to, £3,900 or something, which would be a very useful payback to the individual here, to Charles, given that his business is making losses and the only other income that he has is his property income of £6,000. The remaining loss, we've got £84,000 of loss. We'll have used here £31,000 of that loss. The remaining loss will be carried forward to set off against, when they eventually arise, future trading profits of that same trade. Okay. What you may also find useful in terms of a written problem here is that you might want to keep a little working going called a loss memorandum. Now, your loss memorandum, not very much room here, but let me see if I can just fit it in just to show you. Your loss memorandum, you'd start with what was the loss that you were dealing with. That was the loss of the year ended December 18, year ended 31st December 18, and that was, what was it, 84,000? 84,000, I think. We then show the claims that are made. We looked at the current tax year. Oops, the current tax year there. We didn't make the claim. We then looked at the preceding tax year, and that was 31,000. And that therefore left, 31,084 is what, 53,000, and we could say that is carried forward to set off against future trading profits. You'll see a rather prettier version of that, of course, when you look at the model answer. So, I'd like you please, therefore, to have a little go at that particular exercise, and then come back and join me and we'll have a quick review. Okay, well, hopefully you've now successfully performed that example 2 there. As you can see, the first thing that we did was work out the assessments for the accounting periods to know in which tax years those profit figures would appear and the nil assessment arose. As soon as you knew which accounting year the loss arose in and related that to the tax year, you then knew that that was the current tax year in terms of any loss relief claims. We then set up our working tax year by tax year, though of course we couldn't touch the 16-17 year. That was 2 years ago, and we can only carry back for 1 tax year. Put the figures of trading income in, put the property income in, and then we ignore a claim against the total income of the current year, and that of course is made reference to here. We do make, albeit it's not a hugely efficient use of the loss, because we will be wasting all of that personal allowance, it's the best that is available in the current circumstances. So we use 31,000 to avoid otherwise paying tax on 19,500. And where that came from, you would have had 31,000 total income. You would have had to go against it a personal allowance of 11,500. That therefore, I think, would have left you with £19,500. The balance of that loss would therefore be carried forward. We did a little loss memorandum for that. I've just got a reference to it here. One thing that we haven't yet seen is that we mentioned about a cap apply. Now, we'll see this coming up again in our next lecture together. Just one little amendment. Hopefully this will be amended by the time you are not looking at this anyway. But it says here, as the total non-trading income for the tax year 18-19 is 6,000, is less than £50,000, the cap on the income tax year, income tax loss relief is not relevant. This comes up, as I said, in section 4. Now, in fact, it shouldn't be saying 18-19 there, because we're not making a claim against 18-19. We're not making no claim against 18-19. There is the claim against the total income. What it means is, as we will see in section 4, that we have this cap that is a minimum 50,000, it may be higher, but that cap only applies to other non-trading income. So here, that trading profit, £25,000, that was always going to be available for a reduction, whether that was 25 or whether it was £65,000, it doesn't matter. The £50,000 cap would not be applicable to it. The 50,000 cap, as we'll see in the next session, is relevant to the other income. It's only 6,000 there. So that reference there should have been 2017-18. Hopefully by the time you're looking at it on your version of the notes, it's already that anyway. But just in case you're looking at this version, be aware, please. Okay, review through what we have done and that cap and various other things, we will continue with our study of trading loss reliefs for the unincorporated trader in our next session together.